Everyone is exposed to some type of risk every day, whether it's from driving, walking down the street, investing, capital planning, or something else. And let me be very honest with you, investing in the stock market is risky. If you think that investing in stocks is as safe as a cash or bank deposit, then you're completely wrong. Although historically speaking, stock market investment has given the best returns compared to gold, bond, funds or other options. Still the return from the market is not guaranteed and you may even lose your entire capital in the market. Now, I'm not trying to scare you, but I'm just highlighting the fact. Over 90% of our population lose money in the stock market. Why? Because they do not understand the different types of risk involved in the stocks. Successful investment is all about managing your risks and not avoiding it. A beginner who starts swimming knows that it's dangerous if he goes in the deep water before proper training. He knows that he might even get drawn in the water. However, when it comes to the stock market, people just ignore the different types of risk involved in the stocks and they're ready to dive in immediately. Nevertheless, if you know the risk, the chances are that you can at least mitigate or you can have a backup plan for it. So let's have a look at some of the stock specific risks today. Number 1, market risk. This is also called systematic risk and is based on the day-to-day price fluctuation in the market. The market indices like Sensex and Nifty goes up and down throughout the day, and many a time it may affect the return from a stock that you have invested into. For example, if the market is going down at a time, then it might pull down the prices of even some of the good stocks out there. Number 2, taxability risk. The government changes taxes all the time, and hence taxes may increase or decrease in the particular industry where you have invested. The change in taxation can affect the stock price. Further, there are few industries which are taxed comparatively higher to other, and hence their profit after tax may be less. Further, as taxation is controlled by the government, there is not much that the management of the company or the investors can do about it. For example, a friend of mine was holding the stock of ITC. The stock crashed more than 15% in a day when the government increased taxes on cigarettes. However, before investing in this cigarette giant company, he always knew this might happen and was willing to take the risk. Further, as a backup plan, he had divested his portfolio, which means that although ITC was down, the other stocks in his portfolio were doing great. Therefore, the overall impact on his portfolio due to the poor performance of ITC was quite small in nature. Number 3, headline risk. The risk that a company may decline in share price because of the negative news coverage. See, it doesn't matter if the news itself is true or not. The headline risk can cause significant volatility in the short term. For example, an unconfirmed report of a corporate management shakeup might be picked up by competing newspapers and television networks, and then it can cause a sharp decline in the company's stock price. Number 4, rating risks. Rating risk occurs when a business is given a number to either achieve or maintain. Always keep an eye on these credit ratings of a company. Good ratings helps them to get cheaper debts, which increases the overall profitability of the company and eventually yours as well. Number 5, obsolescence risk. Obsolescence risk is the risk that a process, product or a technology used or produced by a company for profit will become obsolete over time and it will not be any more competitive in the marketplace. See, there are a lot of examples if we talk about obsolete products. Kodak, Nokia, PCO booths, floppy disk, VCRs, fax machines, and the list can go on and on. So try to invest into futuristic companies and not into contemporary companies. Number 6, legislative risks. One should always keep an eye on the government changing regulations, which in turn is affecting the company for good or worse. Let's talk about how the oil companies work, for example. Government gives them a margin which they can keep for themselves. See, every entity in a country is bound to obey their government, right? So now if the government says that you cannot keep 4% but only 2% margin, so what will happen? The stock price for this specific sector would collapse as their profitability is cut down by 50%. So it's quite imperative to keep an eye on the legislative changes as well. Number 7, Commodity price risk. It is the possibility that commodity price changes will cause financial losses for the buyers and producers of a commodity. For example, automobile manufacturers face commodity price risk because they use commodities like steel and rubber to produce cars. So, if, for an example, if the price of steel and rubber increases, then the overall profitability of these firms will decrease and the investors will also bear the burn of it. Number 8. Interest risk. The interest rates changes from time to time and this can positively or negatively affect the stock depending on the direction in which the interest rate is moving. For example, when the interest rates are high, a company might find it difficult to borrow money. As their costs go up due to interest rates, it's harder for them to stay in the business. Number 9. Model risk. It is quite similar to obsolescence risk. A business model running fine from the last 5, 10, or let's say 20 years can abruptly fail due to a disruption in technology. Let's understand this with the help of an example. Kodak was great at making analog cameras, but they collapsed as they did not revolutionize themselves and worked on the digital cameras. They just did not put enough money in the R&D department and they eventually failed. See, no matter which company you choose, there would always be 4 to 5 kind of risk associated with a particular stock. A prior knowledge of these risks will make you more confident while purchasing that stock. Plus, you can always control the amount of risk that you want to take. The risk is reduced over the long term. A short-term fluctuation won't hurt your portfolio in the long run. Further, most of the short-term market fluctuations due to market risk or maybe headline risk will be nullified when you invest with a time horizon of more than 15 years. So, summarizing what we've learned today, risk is broadly categorized as the chance an investment's actual gain will differ from the expected gain. Number 2. The most effective way to manage investments is through regular risk assessment and diversification. Number 3. One should plan for a long-term horizon when it comes to the stock market as the risk is reduced over a time period of more than 15 years. Now, as always, I'd like to end the video by giving you a call to action. We will try to understand how small change in company's profitability can lead to a drastic change in company's long-term growth. So I have a little exercise for you people. In the description, you'll find a link under compound interest calculator. Open the link and you'd be asked to fill up some values. Put the initial value of the company as 1 crore and profit as 20% for 30-year time period. Check out the final value. Now decrease the profitability slightly to 18% and check the results again. The value at which you are looking right now sums up the power of compounding. And as Einstein has once said, one who understands earns it and one who doesn't pays it. So that's it guys. वीडियो अगर अच्छा लगा तो लाइक कर देना और हमारे चैनल को सब्सक्राइब भी कर देना. Basically this video was a part of the basic stock market course that we have created. You can click on the I button to watch our other videos as well. So thank you guys for watching the video. This is Srijan Barnawal signing off until we meet again.